Namaskar, and thank you for joining us here on our weekly program on geoeconomics. Today we'll put into context reports that major Wall Street funds are reducing their exposure to Chinese markets and instead increasing their investments in India. The $62 billion hedge fund Marshall Wace has positioned India as its biggest net long bet after the United States. An arm of the Zurich-based Vontobel Holding AG has also made the country its top emerging market holding, and Janus Henderson Group PLC is also exploring fund house acquisitions. Now, Japan, the traditionally conservative retail investors there, they are also embracing India and paring their exposure to China. Karma Capital, which manages India investments for institutions like Norie's Bank, says that US investors are especially eager to enter and learn more about India. So to discuss this trend in a larger context, we have with us Dr. Naresh Maheshwari, who holds a doctorate in capital markets and is a senior stock analyst. He's with us in the studio. And we'll be joined by Dr. Ambareesh Baliga, who's a senior stock analyst with over 3 decades of experience, joining us from Mumbai. But for the moment, let's turn to Dr. Maheshwari. Dr. Maheshwari, now investors are looking closely at both India and China, but they're choosing to hedge with India. Why is that?
I think when a investment comes to in any country, it is a fulcrum and it is the culmination of so many factors. More political and less economical. The political stability in India has given them a long-term horizon and long-term hopes. But despite that, we must understand that India is not new China. India is not a version 2 of China. India has got its own strength, and we are just not counting on the certain hindrances or certain difficulties which are being faced by the Chinese economy. For example, their unemployment is miserably, terribly at a very high figure. Youth at almost 20% are down. Competitiveness has gone down. Their local issues has gone down. But comparatively, India is going and gaining on its own strength. And the major thing is the manufacturing hub for the auto and other things. We are already doing very well on the software. Third important thing is the digital India. The India has given a way that financial industry, the financial mechanism, the fintech can be the leader in the next generation. So maybe this decade belongs to fintech, the financial participation, and therefore India has got its own strength.
Right, indeed. Dr. Maheshwari, you know, the Finance Ministry estimates GDP growth of 7% is going to be in financial year 24-25. Now, since GDP and market cap seem to be directly linked, what's your outlook for the markets for 2024-2025?
Of course, as per the report, we are very bullish on the Indian economy and the Indian stock market. In addition to that, we have seen whenever a new government comes into place, the first 2 years they take a lot of good steps, lot of action, lot of the measures to boost the real economy. Because the pressure of election is not there, so that appeasement things are not there, or real work has been taken place. So we have seen last 5-6 government, the first 2 years of the government gives almost 40% of the total growth which we achieved in the 5 years. So it means next 2 years definitely are going to be very bright for the India on basis of its own strength. Continuous FDI support, continuous FFI support. Of course, we are now, as you have said very rightly, the Wall Street is dumping other countries, and we are the natural choice for that.
Indeed. We are also joined by Mr. Ambareesh Baliga, a senior stock analyst who's joining us from Mumbai. Mr. Baliga, you know, a CRISIL report, it sees that the Indian economy is growing consistently at 6.7% annually from 2024 to 2031. So will investors be looking, you know, at the long-term story? And where's the market headed 5 years from now?
Good evening.
Good evening, sir.
See, I mean, if you're talking of longer term I mean, I don't think there is any doubt that India would be the place to invest. India would be the country which will be growing the fastest. And I think we are talking of India possibly becoming the third largest economy by 2030. So you really can't go wrong as far as India is concerned. But then one should always remember that the markets are just not a one straight line up. We will have some corrections in between. Having had an extremely good 2023, which was, I think, much beyond anyone's expectations, 2024 may not be as good as 2023 because we have elections in between. And whatever said and done, elections mean at least some amount of uncertainty as such, although people are expecting clearly that this government will come back with a much larger majority. And I think the best is already discounted. So 2024 may not be as good as 2023. We could see some correction in between. But then if you're talking of investing for the next 5 or 6 years, even at these levels, you really can't go wrong. But we should remember that there can be corrections in between.
Indeed. Mr. Baliga, we'll continue with you. Is the slowing of growth in other countries like Russia, South Korea, South Africa, is this pushing investors towards India as well, apart from those people who are moving out of China?
Absolutely, because liquidity, which is what people invest into various markets. Liquidity normally flows into those markets which are doing comparatively better. And that's one of the reasons why, FIs, despite having moved out in the earlier part of 2023, came back and started investing in a big way, because this was the market which was performing. And that will continue as long as the market performs.
Indeed. Let's bring back Dr. Maheshwari into the discussion. Dr. Maheshwari, how global are Indian stock markets? Now that the Japanese retail investors are expanding beyond their traditional focus on the US markets, they're paring their exposure to China. They seem to be interested in India. So in this context, how global are we? How many international buyers do we have?
Yeah, I think the FPI, if we go by the registered number of FPI, which has got accreditation from the SEBI, runs to various high figure of thousands. So it means the foreign FFI and the foreign participation in India is very widespread. And after the total activation of the GIFT City, where international trading are matching the international standard, international cost and international taxation system, and not only that, international timing also. Some way we can say now India has become a real true global world stock market. In Indian regular stock exchanges also, they are in the process of extending timing to take care of the abroad market. Maybe an evening shift between 6 to 9 p.m. Maybe started very shortly. So that will also take care of the other economy and other things. The FPI regime and the KYC, limited KYC regime has been made quite liberalized, and it is now both way. RBI also permit to invest in outside stock, and sitting in India because of the GIFT City, because of the arrangement between BSE and NSE, now we can buy the shares of, maybe if you want to buy Apple sitting here, you can buy Apple, you can buy Microsoft, so both way. So if American citizen wants to buy in India, they can buy our TCS, Tata or Tata Steel. So it means in a true sense, it is now have become a two-way process, and the number of FFI, as I told already, in terms of amount also, in terms of billion also, this year we have seen not only the capital market, but in debt market. After 2019, after a gap of 3-4 years, we are seeing a huge amount coming in the debt market also. So a vibrant market is not only the stock market. Once we talk of the financial vibrancy, we takes care of all the three things. The foreign currency reserve, we have in abundance, no problem on that. Then we require the stability in the currency. So India's government and Indian rupee is faring very well in accordance to, as compared to other countries. And the last is the timing and the cost and infrastructure. So I think we are now using all best technology. The things we are starting, maybe the same day settlement, which is nowhere in the world. Right. So I think we are becoming the world leader. So time has come where world is going to follow us.
Absolutely. Mr. Baliga, India aspires to be the third largest economy in 5 years. We're pretty much on track to achieve this goal. The Prime Minister also has made reference to it in context, of course, with the general elections. You just talked about that. Now, given this, how much more weight should the rupee have in international trade?
See, I think the importance of rupee in international trade is surely going to rise. I mean, with the rise of in the economy of India. And I'll really not be surprised if you're talking of the next 5 years, if we start seeing a rupee appreciating against the US dollar, as well as the other currencies as such. Because the last 75 years, in fact, we have seen only depreciation in the rupee. So I think it's a bit difficult for people to even imagine that rupee can appreciate. But that's what I see happening over the next 5 years.
And are you very much in favor, Mr. Baliga, of a lot more international investors coming into India, utilizing the market stretching into longer hours to suit their needs?
I think, that's a given as of now, because that's what SEBI and the exchanges have been thinking about. And I think they are getting a clear green signal from the participants. And I think extended hours should be rolled out possibly later this calendar year. So I think it is good from the point of view of international investors. Yes, it will be a bit difficult for the participants, especially brokers who will have to possibly have more number of people working on this, because you'll have, you'll have shifts as far as the broking hours are concerned. But yes, I think this will increase the sort of volumes which we have seen in the market till now. And overall, I think it should be positive.
Dr. Maheshwari, are there any competitors to India at the current time? I mean, how deep-rooted is the decline in China, for instance? Would Asian investors be looking, let's say, at ASEAN?
I think very important question. I think we must understand that China is a very big economy, and temporary problems will not make them write off. It is only a limited period which has been given to India, and within that period, India has to count upon, India has to prove its credential that naturally that they can produce. International trade, how it takes place? There are only two theories for the international trade. Either it has to be on the basis of cost competitiveness or the productivity basis. So maybe if you just compare our economy with the Bangladesh or maybe Vietnam, their textile business has moved to them because the cost of competitiveness is there. So even in India, if you compare the electricity tariff, even the land rates, to take care of or to set up a new greenfield project, if you compare with any other third world countries, maybe from Asia itself, so maybe Indian cost is still slightly higher, number one. Number two, the China naturally, we can't expect that it is such a deep economy or they will not take corrective measures. Of course, they are suffering. But I think that limited window available to India is for only next 2-3 years. By anything, because like we have said that their unemployment ratio is very high, maybe 20%. It means that now they have an option to reduce the wages because they have to give employment. And both way the labor is ready to natural work, and with low employment, it means their competitive cost is going to come down again. So maybe the things will move again back to the China. And the international trade which follows through the political things, maybe so it means there are three factors. First, the China, maybe after 2 years, again a very strong competitor. Third world countries, emerging economies, maybe Bangladesh, maybe Vietnam, maybe even Iran. We have seen even so many other countries, even in the Latin America, we have seen Venezuela, we have seen so Cuba, even so many countries where they have got the natural resources.
So, but why can't India invest there in these countries?
I think very important question. India is doing that. In India is the first time they are thinking that now, why not Indian company becomes multinational? Multinational, always we were saying, okay, company based at USA or Russia or XYZ country, big countries, opening shop here. Now it is a reverse flow. And particularly if you see the last meeting with our Honorable Prime Minister and the Biden, we have seen there is a sense of relief, sense of understanding. And they have given, why not we try Indian companies? So that confidence between two governments And that is a very strong thing, strong incentive to try India. So at today, our stage is that India is on trial. India has got an opportunity, but how we are able to exploit it, that is the key question.
Indeed. Mr. Baliga, how best can India's strategy, of being the voice of the global south translate into economic opportunities for the global south? And can India, actually invest heavily in the global south?
No, see, India has already started investing, overseas. And what you're talking of multinationals, yes, there are a number of Indian multinationals today, if you look at some of our larger companies, and I think that's going to continue anyways. And if you look at the global leaders, whether you see business leaders or political leaders, quite a few of them are of Indian origin. So that really shows that India's time has come, and India and Indians have earned respect across. So I think this is only going to increase going ahead.
Dr. Maheshwari, can the problem of inflation, which is created by supply shocks, hit our domestic production as well? Prime Minister, in a recent speech in the Lok Sabha, said that inflation is under control. On the macro level, we see that the fiscal deficit is reducing and money supply seems to be stable.
I think there are three questions in this. First is on money supply and the fiscal deficit. I think
all of them concern inflation.
Yeah. So last time the FM in the immediate last budget itself has clarified that this strong and the financial discipline is of very paramount importance to them, and they are trying to reduce, and within the budget, even in a election year, they are predicting that next year the deficit may be 4.5 only percent only. It means the government wants a fiscal discipline. So naturally, it is going to contain our inflation. That is part one, as far as the money part is concerned. The supply part is money supply is part. But that's it. Second is the supply, the chain supply. India is a important player on import, like pulses. Naturally, we import pulses. Then edible oil, we import edible oil. Even certain varieties of the rice, even we have to import. And there are so many other things. Of course, non-consumable, the oil, of course, is there. Gold is also there. So if we take care of the 4 or 5 factors. So as far as inflation is concerned, let us take care of the coil of the crude, pulses, and edible oils. All these things are not in the government hand. So naturally, sometimes shocks in other countries. Maybe Malaysia got the problem with rapeseed oil and other side. It affects our India. Pulses which you are importing from Canada because of some trouble, that itself is being affected. So ultimately, in the long term, in the long term, the thing is that we have to be self-dependent and a buffer stock policy. Ultimately, because the production is not in our hand, how we manage? We have to manage through a buffer mechanism. So we have to create a buffer, we have to create a effective PDS, public distribution system, which not only take care of the basic diets, but also the rice and other things. And our government has done very good when we are talking of the so many other millets. When we are increasing the use of them, that will take care of that. So I think government is already seized of that issue, how to contain inflation, which is food-based inflation.
Indeed. Mr. Baliga, if we look at the markets themselves, some people say that our stocks are also inflated. So, in this context, how does this all affect the retail investor, especially when there are lots of people interested, lots of investors interested from overseas? Is there an opportunity for them to make money or otherwise?
No, like I said, there's always an opportunity for investors in the longer term. But the short to medium term, I would say that the markets are slightly overpriced. If you look at the markets overall. But then if you look at the mid cap and the small cap side of the market, I think there is excessive overvaluation. And I suppose there should be a very decent correction in that part of the market. If you're talking of the blue chips and the large caps, I think the valuation is decent, slightly on the higher side, but not too high. And I think if you're talking of the international investors, they normally look at the large caps and the blue chips to invest in, or the larger mid caps, which, like I said, it's not too overpriced. So there is an opportunity there, no doubt. But if you're talking of the mid cap and the small caps, the retail investors in India should be a bit careful at this point of time, because if you look at market wide, we have about 2,300 to 2,400 stocks which are quoted on a regular basis, and out of these, close to 600 stocks have become multi-baggers. And when I say multi-baggers, a 2x means a 100% return.
Right.
And there are so many stocks which have given you at least a 5 to 10x sort of a return in the last 1 year,
Right.
which is, something unimaginable. So when this sort of a thing happens, one has to be a bit careful, because if you get carried away, possibly, you could end up with a huge amount of losses. And most of these retail investors, are the people who have actually come into the markets in the last 2 to 3 years, and they have only seen profits and they have not seen losses. So once they start seeing losses, possibly there can be panic. So that's what I think one should be a bit careful about.
Right. Dr. Maheshwari, India's markets have grown from $500 billion to $3.5 trillion in the last 20 years, the market cap. So many people, look to get rich using the stock market route. So what advice would you give common investors who want to make the most of the market sentiment? Or should they be looking, in fact, for tips from Marshall Wace or those kind of groups of the world?
First of all, I fully endorse the view of Mr. Baliga. The market are slightly overheated, but there is a valid reason for that. Our market works on the basis of promise, not on the basis of the performance. When we talk that India is going to be that much economy, third economy, is going to replace China. So all these naturally infuse the sentiment. It gives a good credibility to the sentiments, and naturally investors are flocking the stock. But we have a limited stock. We have limited papers, and the same stock is now being bought by mutual fund, by SIP, by the retail investors, by even the domestic and foreign institutions. So price is slightly overheated. But as far as tip is concerned, my tip is only that when they are buying a stock, they must understand what they are buying.
Okay.
Just blindly following any advisor may not be the right thing, because the price today is not that where it can be a simple investment. They have to understand, like you take an example of IT sector or maybe the chemical sector. Chemical and IT sector have not shown any tremendous growth last 2 years. But whereas you go to the real estate, you go to the multi-bagger or to the small cap or to the SME sector, every share in SME is 3 times. So that cannot be the market. Some industry may work, some will not work. So when they are taking penny stock, then the SME stock or the small cap, naturally they have to be very, very careful.
Indeed, but Mr. Baliga, if we say that the market cap is worth about $3.5 trillion, India wants to be a $5 trillion economy soon, and we are hoping to be the third largest economy in, let's say, 5 years' time. So in this course of time, obviously there's huge room for the market also to expand, isn't it, in terms of market capitalization? So in that context, there is obviously an upside.
Absolutely. There's an upside, no doubt. Like I said earlier, there's a huge upside from here. But then this upside will not be a one straight line. You will have decent corrections in between. So you should have the wherewithal of holding on to your investments during those down times. You should not panic. Number two, it's not necessary that every stock which is quoted today will be 3 times or 4 times in the next 5 or 10 years. There'll be a number of stocks and companies which will disappear over the next few years because the performance may not really match up. So it's not necessary that the stock which you are holding will be 5 to 10 times in the next 5 years. So you need to choose your stocks carefully. You should understand what you have bought so that you have the confidence to hold on to those stocks in the downturn. And you should, in fact, you should be buying more in the downturn if you have that confidence in the stock. This is what will give you those returns in the next few years.
So final word from you, Dr. Maheshwari. So the hedge funds that are betting on India, they are betting for the long term, aren't they? It's not just a temporary period of time that they are thinking that let's hedge our money here for the moment. India's growth story is intact. For let's say for the next 20, 30 years maybe.
Yeah, I perfectly and fully agree. India has become a nebula. A nebula is the pre-stage of becoming a star. So very soon we are going to be a star amongst the capital market of the world, amongst the economy of the world. And the hedge fund, though by definition they are short-term, but because the returns is very handsome in India, we hope that they will invest for a longer vision.
We'll leave it there. Thank you very much, Dr. Naresh Maheshwari, doctorate in capital markets, senior stock analyst, and Mr. Ambareesh Baliga, senior stock analyst with over 3 decades of experience. Thank you for your insights and enlightening us on this interesting subject. In conclusion, let's say this, that CRISIL, which closely watches the capital markets, sees India's growth coming from the government's investment-driven approach at a time when the private sector was reluctant to invest. Now, this is the same proactive approach that S&P sees in India, making it the fastest growing emerging market globally. S&P also agrees that India will become the 3rd largest economy by 2030. India is currently the 5th largest economy in the world and is fast catching up with Japan and Germany, who are less than $700 billion ahead of India currently. So India is fast growing, as we know. Thanks very much for watching. Namaskar.
It's